Hello everyone, this is Nolan McIntosh with McIntosh & Associates with the second quarter market update. As always, try to shed some light on where we were and hopefully provide you some useful information on what lies ahead. Well, no matter how you want to choose to describe it, the second quarter of 2020 was historic. The quarter opened with spiking coronavirus cases, shuttered companies with scattered employees, and an economy that would remain mostly closed for business for 6 weeks. Every news headline was grim, full of stories about horrific unemployment numbers, increasingly restrictive stay-at-home orders, and rising death tolls. Markets, however, seemed to shrug the doom and gloom off as they steadfastly marched back up from their quarter one lows. The market's rebound started slowly, held back by astonishing unemployment numbers and instability around oil. Following the almost countrywide shutdown, nearly 7 million people filed initial unemployment claims in late March and by the end of April. The total unemployment rate came in at 14.7%. It's a staggering number, especially when compared to February's low of 3.5%. Oil too was hit hard by the shutdown. Price war between Russia and Saudi Arabia compounded the oil industry's problems, and prices plummeted in response. With people staying at home and travel nearly halted, oil struggled to overcome too much supply and too little demand. But as April turned to May, lights began to flicker back on in states across the country. One by one, states started to reopen, some flinging the doors wide open and obviously some cracking open a window. It was forward progress no matter how slow, and optimism bloomed as people began returning to work and life started to resemble something that we could recognize. As optimism rose, so did the markets, and they didn't just rise, they rocketed. When the surge finally leveled off, we had recorded the biggest 50-day jump in stock market history. The upward trajectory was bolstered by a surprise May unemployment number, which gained a 2.5 million jobs, a gain of 2.5 million jobs instead of a loss of 8 million. The overall unemployment rate dropped too, hitting 13.3% instead of rising to nearly 20% as everyone had predicted. As we started slowly to reemerge and re-engage, things started to look brighter. Then the gruesome death of George Floyd by a Minneapolis officer was caught on video, sparking protests, rioting, and looting across the country. Markets, however, seemed unaffected by the commotion, climbing higher by early June. The Nasdaq had erased all of its losses by 2020 and surpassed the 10,000 point level for the first time, driven primarily by big-name technology stocks. The S&P 500 and Dow had its own startling rebound in their own right. In early June, the S&P 500 turned positive for the year for a brief spell. Record-setting unemployment rates, plunging oil prices, and high levels of volatility created concern for investors in the early quarter two. These concerns were offset by rising optimism in June. So what does quarter three hold in store for us in the U.S. markets? In short, the market rebounded in a perfect V. But as we enter the third quarter in the second half of 2020, one question obviously still looms. Will the overall economy follow the market's lead? The market's optimism in late May waned by late June, deflated by ongoing protests and renewed fears that a second wave of coronavirus was holding things back. Concerns remain too about the possibility of a second shutdown or a delayed reopening in multiple states where infection rates are starting to spike again. It's still too early to assess the total damage of the first shutdown, and a second shutdown by all means would make a bad situation worse. However, when we should be able to get a clearer picture of where the economy stands. Second quarter GDP won't be out for another several weeks, but it seems reasonable to obviously expect another negative second quarter. While some people have returned to work and at the end of June, millions of Americans were still unemployed, there's still good news. All 50 states have reopened in some fashion, and as companies resume operations, weekly unemployment should continue to decline. Consumer confidence has been ticking upward steadily since the shutdown. As the country continues to reopen, consumer confidence should only increase. Oil prices, which were decimated in March, have rebounded and mark one of the very few bright spots on the horizon. The wild card will be how quickly can states get back up to running at mostly full capacity, especially as infection rates rise and protests and rioting continue. As we return to normalcy, it will be difficult to gauge how U.S. consumers will react. Will some of these scars take a while to heal? The obvious answer is most likely. Investors obviously should remain cautiously optimistic as we navigate into new territory going into quarter three. Volatility will continue to create drama in the already sensitive markets, impacted by both positive and negative headlines. Although volatility has improved significantly from the first weeks of quarter one, it remains in the mid-20s and 30s, high compared to historic average in the mid-teens. The primary cause for caution here is that with volatility at historically elevated levels, market movements can obviously be dramatic. That's a cause of great stress to investors, so make sure the strategy that you employ is to pursue your goals to address that volatility. As we ended the second quarter, we have climbed out of the darkest depths. We are still a long way from where we were before the coronavirus arrived. To make sure you stay on your journey, you might want to ask yourself this question. How did you feel about your investments during the first half of this year? It's obviously natural to have doubts and concerns, but if you were driven to despair because of your portfolio, the market has given you a golden opportunity, a literally golden opportunity to step back and reevaluate. If you were comfortable with the market ups and downs over the past few months and you feel like you're still on the right but somewhat rocky road, then stick with it. If in times of the market turmoil, the best thing you can do is rely on your financial advisor to keep you on track, obviously we're here for you as well. We will give you that information and perspective and encouragement that you need on that journey. Unprecedented, uncharted, or unbelievable, no matter how you want to characterize the first half of 2020, it will obviously go down again in remarkable history. We've emerged stronger from this period, both as an economy and as a country. Thank you for your time. Again, this is Nolan McIntosh from McIntosh & Associates. If you have any questions or want to look at your current financial situation, two ways to get a hold of us. On our website, www.wealthmichigan.com, or you can give us a call at 989-692-2200, and we'd be happy to talk with you. Again, that's it for the quarter two update. We look forward to talking with you again at the end of quarter three. If we can help in any way, just give us a call or contact us on our website. Have a great one. Bye-bye.